And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Thursday edition. It's the second best day of the week of a holiday shortened week. It seemed like just yesterday was Monday, today's Thursday, tomorrow's Friday. I don't know, I'm so confused this week. But anyway, we've started off the brand new year, of course, the last half of the year, brand new month, brand new quarter. And of course, as we will be talking about here in much more detail, and we noted this yesterday, earnings season now getting underway here. So we're about to start getting next week. A whole deluge of corporate earnings will be coming in. The things that we want to be watching for. These are going to be kind of the key themes that'll be important to the markets if this market's going to continue its advance. One is that earnings continue to improve along with outlooks. As we noted yesterday, the S&P has been actually cutting estimates rather sharply over the last month, heading into this quarter. So again, not surprising. This always happens. They cut estimates this way. We get a high beat rate. Companies come out, beat their estimates. It's all great. But as investors, we need to be looking kind of underneath the hood saying, okay, what is the quality of these earnings? Are these earnings improving at the top line, right? Are they selling more stuff? This is going to be really the key issue, particularly if you're looking for that recessionary onset. That's the thing you want to be looking for. Are they selling more stuff, right? Because just because I can manipulate the bottom line of earnings per share, so this is, when they announce earnings, our earnings per share were, $31, billion in earnings, and our EPS was $1, whatever it was. That's all after taxes, depreciation, amortization, the write-offs, the adjustments, the stock buybacks, all that. So there's a lot of potential ways to manipulate that bottom line earnings, but sales at the top line, what actually came in, that revenue, that's really hard to manipulate, right? So that's a pretty good raw number. So the question, if you're worrying about a recession, is that number getting better? Because if that number at the top line is getting better, that suggests that, consumers are still spending and the economic growth is still going on. In fact, might actually be improving. So that's going to kind of, put off that recessionary impulse if consumers are spending more money. So watch that top line. That's really going to tell you a lot about where we are within this current economic cycle, et cetera. Now, once we actually start getting into these earnings reports, what will be important for the market, particularly after this big run we've had this year, is going to be their outlook. Is their outlook still strong? Now, if we take a look at a lot of the economic indicators, even yesterday, some of the economic data coming out, fairly weak. Factory orders were down, still suggesting there's real weakness kind of running underneath the surface of the economy. And so if their outlook isn't improving, that's also going to potentially weigh on stocks after such a strong run. So, there's going to be some really important things that we'll be going through here over the next, couple of months as we go through all these earnings reports. But, after the last quarter, that bar kind of got ratcheted up for a lot of these stocks to, in order for them to beat these estimates. That bar was kind of lifted because of their outlooks for the year. So again, if economic weakness has started to pick up here, that could really put some of these I shouldn't say some, but it could put the market in particular at a little bit more risk. Now, yesterday the markets kind of had a sloppy open, but kind of rallied back in the day. Still finished negatively for the day, but fairly close to break even. It wasn't really too bad of a day. But this morning, futures are pointing again a little bit weaker. Dow's down about 140 points this morning. Of course, tomorrow is the big employment report. So that's going to be really kind of the focus of the markets, particularly, and we'll talk with Michael Liebowitz more about this morning, is, the next Fed meeting right around the corner. And, from the last Fed meeting, a lot of the Fed members, and particularly the voting Fed members, have already kind of started moving their expectations up for at least one more rate hike, if not two, this year, because inflation still remains pretty sticky at this point. But, that's going to be the view for the markets, right? What's the Fed going to do? Are they going to get tighter monetary policy? Are they still going to be hiking rates? Remember, this whole rally from the October lows has been predicated on this idea that the Fed was going to pause and start cutting rates fairly immediately. But the idea of any type of rate cut now has really been pushed off into later this year. Okay, but here's the important thing, and this is what you need to know before the bell this morning. Got a lot of questions here over the last few days, in particular about bonds. Bonds have been under a little bit of pressure here, particularly since the Fed has started talking about needing to hike rates a little bit more. 10-year Treasury has been under a bit of pressure. Longer duration rates have been going up, about 3.9% right now. Still within, we're just been trading back and forth within this kind of range between 3.5% and 4% now. It's no big deal. But, we've been in a very long period of pressure on the longer duration end of bonds, right? So the 10-year, the 20-year, 30-year bonds been under pressure here because of what we saw with economic growth. Here's the key point. Interest rates are not controlled, on the long end, are not controlled by the Federal Reserve. The Federal Reserve controls the short end of the yield curve. They control the 3-month, the 1-year, the 2-year bills. The long duration assets, the 10-year, the 20-year, the 30 years, those are driven by economic growth and inflation. Now, the reason that interest rates moved up over the last year or so in particular was because we had this massive monetary impulse into the economy that created inflation, a very strong surge in economic activity, and so interest rates in the longer end went up, and that's why mortgage rates went up. We had a lot of demand for houses, etc. All that's coming up. All that was pushing rates higher. Now the question you have to ask yourself, I'm getting a lot of emails about this. They're like, well, the Fed's hiking rates again. That means interest rates have to go up. No, keep a watch on what's going on with the economy. If you're expecting a recession and expecting a slower economic environment because of higher rates, slower economy, and what's happening with inflation right now, inflation's coming down, those are what drive the long end of the curve. And when you start taking a look at a long-term chart of interest rates, bonds have never been, and interest rates in particular, have never been this depressed really ever since the beginning of this century. So now that's only going back 20 years, but going back 20 years, we've never been this oversold in terms of interest rates, and we're just about to trigger a monthly buy signal on bonds right now, and that would suggest slower economic growth and lower rates of inflation here over the next year. But in particular, every time that we've had these type of signals, these have been really good opportunities where we have seen a point in time where bond prices rose and yields fell, and that's exactly what you would expect with a slower economic environment, lowering inflation. And then, of course, ultimately, if you're betting on the Fed to start cutting rates, that's even suggestive even more that you're near a trough in bond prices, because as they start to cut rates, they're going to be cutting rates in response to either a recession or much slower economic growth. They're cutting rates to try to support economic stability. So as the Fed starts cutting rates, that's in response to a much weaker activity. That means yields will be falling, bond prices rising. And again, there's a lot of negative positioning in bonds, which will provide that eventual fuel for a rally in bonds as we get into really 2024. But again, this is a longer duration asset. This is going to require a period of time for inflation to really come down towards that 2% level, and of course, probably even less at this point. But also as economic growth begins to slow even more. And again, economic growth has been slowing, but we haven't got to that point in time where we're back towards a real recessionary concern. So again, that may not be this year. And the questions I get is like, well, interest rates are still going up. Yeah, we're still in this process. And if you're betting on a longer duration asset, this just takes more time. And so you've got to give this the time for economic growth and inflation to get to the point that bond prices and yields begin to respond in kind. And we're probably getting fairly close to that. But again, we'll keep a watch on this. But again, a lot of emails here lately. Just keep a watch on this. Watch economic growth and inflation, because that's going to be the driver for yields and bond prices as we get out into 2024. But that's what you need to know before the bell this morning. When we come back from the break, I will pick up with Michael Leibowitz, and we will get into the Fed and potentially what they're going to be doing next. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence and prepare for the second half of 2023 with the RIA Mid-Year Economic Review, Saturday, July 22nd, with Richard Rosso, Danny Ratliff, and special guest Chief Investment Strategist Lance Roberts. Get our report card for the market so far and what you need to know to invest profitably for the rest of the year. Register now for the RIA Mid-Year Economic Review, Saturday, July 22nd, with Ratliff, Rosso, and Roberts. RealInvestmentAdvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. It's Thursday, of course, as I said. This morning, Janet Yellen has arrived in Beijing to have meetings there. She always likes going to Beijing, by the way, because she's not the shortest person in the room. And she took cookies. So there you go. Anyway, this morning, Michael Lewitz joining me. Tomorrow, of course, is the big jobs number that's coming out. Of course, that comes out every month. And, we've had a unprecedented string of beats where the employment number has come in much stronger than expected. And not just by when I say unprecedented number of beats, it's not by a small amount. We've had 15 straight months of the employment report beating estimates. That has there's no other period in history of the employment reports where we started tracking estimates versus the actual number that's even close by like 10 months. I mean, like the most there were at one time was like 5 to 6 months worth of where the number was beating estimates. But to be at 15 months and potentially 16 months as of tomorrow, if they beat numbers again, this is something that's just never happened historically. Now, this of course elicits a lot of questions about the validity of the numbers. Is this, is this part of the mathematical adjustment? Is there something wrong with the mathematical adjustments that we use because of what we did by shutting down the economy, then having to restart the economy, or some of these mathematical adjustments that are made, these assumptions like the birth-death adjustment and others, have those been skewed by this unnatural shutdown of the economy? So but whenever you have a period where you've got 15 months of a some number outperforming long-term estimates and long-term models, this elicits the question: is there something wrong potentially with the model? Right? Do we need to go back and examine the model? Don't know that answer. But one thing we do know is that for 15 months, particularly 16 months, that number has remained very strong. And this has been one of the key drivers behind the Fed's outlook for interest rate hikes, right? Employment's strong. That means people are making money. Wages are going up. So we need to keep hiking rates because that strong labor market and high and that tighter labor structure and higher wages, that's inflationary because that means people are working, they have money to spend. 70% of our economy is consumption. So until that number weakens, a potential for an inflationary resurgence is one of the big fears of the Fed. So again, all eyes are going to be focused on this, this number tomorrow. If that number comes in extremely hot, another 300,000 plus print like we saw last month, that could potentially worry markets here. Mike, well, kind of what are you thinking here about the employment number tomorrow? What should we be concerned about?
Well, I think you're absolutely right. And look, whether the BLS is getting the number exactly right, they're not, but it doesn't matter. They're getting the health of the market, the trend of the labor market correct. And we know that because of ADP, because of JOLTS, which the BLS does do, because of unemployment claims, because of the manufacturing and service sector surveys. They have all been very strong. So it's kind of incumbent on us, because we know recessions do not happen until the labor market starts to falter, to watch this whole range of employment numbers, in the BLS, but there's a bunch of others too. Mm-hmm. Yesterday, I don't even know what day today is anymore. I think it was yesterday. ISM manufacturing came out and its employment indicator was lower. Now, that's not surprising because the manufacturing sector has arguably been in a recession now for a while, but it's a relatively small percent of the economy. What's going to be important this morning is ISM servicing sector, service sector. That is, the broad index is hovering just above 50, which means the economy is still growing, but at it's borderline with contracting. And within that, we'll look at the employment survey and let's see if it's able to hold above 50. Because again, the bulk of employment occurs within the service sector. We're continuing to look at jobless claims, which have upticked, and they're at the higher end of where things were in 2019, but still there's nothing concerning yet. Mm-hmm. And same with some of these other non-BLS numbers. So, again, we can debate all day whether the BLS is right or wrong, but directionally they're correct. And I think as investors, we have to think directionally. Yeah. Is the labor market continuing to strengthen? Because if it is, the Fed is not going to take their foot off the brakes or off the gas, right. Off the brakes, not gas. And in fact, they'll probably raise rates July 26th if this number tomorrow is relatively strong.
Yeah, just to put a little, some numbers behind, the things you're talking about here. S&P Services PMI this morning. So on Tuesday, I forget what day it is either. So it's either Monday or Tuesday. 4th. I can't remember, but yeah, it was the manufacturing side of the S&P and ISM came out. So today we've got the services side of that data coming out. S&P Services is expected to come in at 54.1. Which is the expected number. ISM Services, which is the one that most people look at, that number is expected to come in at 51.3. That will be up from 50.3 previously if that number comes in. So they're expecting some improvement in the services data. That would not be surprising because we've seen an uptick in consumer confidence, and consumer confidence tends to lead the services index. So we'll potentially see some stronger demand on the services side. That's not really a good number. That shows the economy is in expansion, right? So we're not, not in contraction. And again, that's potentially inflationary if we start to see the services number pick up. Services make up about 80% of the economy now versus manufacturing. So when you take a look at the economy and how it's structured, these services are going to have a lot bigger impact because this is people spending stuff on, food delivery services, experiences, those type of things. And, that could feed into an inflationary uptick, keep the Fed on a much longer term policy of keeping rates high to try to combat that inflationary pressure. Because it's not, these rate hikes that we've had so far have not really created the environment that they want to bring down longer term sticky inflation, that core inflation is not coming down here. And their big concern, as I said before, is a repeat of the 70s where we have a resurgence. You have this decline in inflation. Everybody goes, ooh, good, inflation's over. And then it comes roaring back because it wasn't actually tamped out yet. This is going to keep the Fed, kind of in a tough position. But for the markets that are expecting, again, for the Fed to stop hiking rates and to start cutting rates, this is not the environment for them to do that.
Right. And rates are already very restrictive. And I'm not saying that because a mortgage rate is 7%. I'm saying that when you compare interest rates to inflation, and you can kind of do that two different ways. One is just against inflation. And right now, CPI next month, or this month, I guess, is going to come in the low threes. At the same time, we have rates between 4 and 5.5% for treasuries. So interest rates will be at, in a week or so about 1 to almost 2% higher than inflation. The way the Fed likes to look at it is, what does the market think inflation will be? And if you look over the next 5 years, implied break-even inflation is roughly 2.25%. And at the same time, that's for 5 years. The 5-year Treasury is about 4.25%. That's 2% over what the market thinks inflation will run for the next 5 years. That's a very restrictive level. The last time we had such a level was 2007. It got up to about 2.5% and immediately collapsed because the economy cannot handle such restrictive policy. The yield curve was inverted at that point too, as it is today. It's actually more inverted today. So the Fed is applying, both in their Fed funds, but what the market translates it to for the longer end of the curve, very restrictive policy. The question is, when will it have its effect on the economy? And I think to some sectors like manufacturing, it is. But again, we've said this a million times, all the pent-up all the stimulus and all the pent-up behavioral desires to spend and when they spend are kind of wreaking havoc on all traditional economic models. But it doesn't mean economic physics, the way things work, has gone away. It just means the timing's a little bit different this time than prior times.
Yeah, and again, this is something that and there's there's an important point as Mike and I are talking about inflation. There's an important point about inflation that we'll talk about on the other side of the break, which will feed it. And as I was saying in kind of the opening segment this morning, we're about to kick off the second quarter earnings season next week, and really there's a few little things that are going on before then, but primarily the big banks will start reporting next week. And the thing we're going to be looking for, of course, is looking at profit margins, not just earnings, because profit margins remain well elevated. Well, the problem is potentially that what we've seen in terms of wage growth and higher interest rates and higher borrowing costs, all those type of things, are going to be eating into those profit margins, and then particularly what that means for this bull market rally. We'll talk about that after the break. I'm your host, Lance Roberts, with Michael Lewitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence and prepare for the second half of 2023 with the RIA Mid-Year Economic Review, Saturday, July 22nd, with Richard Rosso, Danny Ratliff, and special guest Chief Investment Strategist Lance Roberts. Get our report card for the market so far and what you need to know to invest profitably for the rest of the year. Register now for the RIA Mid-Year Economic Review, Saturday, July 22nd, with Ratliff, Rosso, and Roberts. RealInvestmentAdvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I get little hate messages from my daughter. She Venmos me her car note every month. When you Venmo somebody, you can put a note at the bottom of the transaction. It's like a memo, like on a check, right? So you say, this is what it's for.
The Real Investment Show podcast. Same show, your schedule.
So she sends me nasty messages, like through Venmo. Right. It's like, here's my car note. I was going to buy a new outfit, but I guess that's over.
At realinvestmentadvice.com.
Here's my car payment. Now I can't eat anything.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report, plus each day's radio show. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So back in 2021 and really 2022, this term greedflation really started to take some root in the financial media and really the mainstream media as well, because it was how could these greedy corporations be hiking prices at a time where Americans are struggling, etc. Well, that's kind of how things work, right? I mean, if there is limited supply of something, and if you make the decision as a government to shut down the economy, keep people from going to work, lock them up in their houses for whatever reason, you're going to restrict supply. And when you have restricted supply of anything, right, and you have demand for it, people, kind of still needed to buy stuff and still needed things, to live their lives. When you shut down that supply and you have demand, well, there's just basic economics 101. Prices are going to go up because corporations are going to go, I only have a limited supply of this to sell. I have profit margins that I need to maintain in order to pay my workers and do, everything I need to do and still generate income for the company. So I have a profit margin I'm trying to keep. And since my input costs, everybody thinks that this greedflation idea was just corporations arbitrarily just sticking prices on stuff. But everybody forgot that all of the input costs to these companies also went up. They had higher labor costs. They had higher input costs. They had higher commodity costs. They had everything that they were going in to build the products that you wanted, what they could produce. All those input costs were going up. So they had to pass on that profit margin issue to consumers. And so, yes, prices went up, and that's why we had inflation. But it wasn't greedflation. That's a misnomer. It was simply companies acting in the best interest of their profitability in order to maintain productivity, et cetera, and to generate issues and generate products and services, et cetera, in a limited environment. That's why you have inflation. And that's what happens when you shut down the economy and give people a whole bunch of money. If you shut down the economy, that's one thing, right? Because demand would have sunk immediately. But as soon as you shut down the economy, then gave people $5 trillion, well, there's your problem. As Milton Friedman once said, inflation is always and everywhere a monetary phenomenon. And that's exactly what happened. So what's interesting now, though, is that companies are now faced with the opposite problem, which is inflation is falling, demand is weakening, and so prices are now starting to come down, and we're starting to see profit margins begin to shrink. In fact, profit margins have now come down to a bit. We're back to about 2020 levels right now in terms of profit margins. They still have a good ways to fall to get back to kind of a normal trend here. But again, as I was talking about before, as we start to move into second quarter earnings season next week, these are the things we're going to be looking for, right? How are these profit margins holding up? Earnings expectations right now are still they were 20% above the long-term mean of growth, of the growth trend of earnings. Earnings are currently at levels well in excess of what the economy can actually generate. So again, expectations for earnings are elevated beyond what the economy can actually generate. Because again, where do earnings come from? Earnings are a function of you producing first, you get paid, you go out and buy stuff. You can't buy stuff if you don't work, right? So unless somebody's giving you money, like $5 trillion. But normally in an economic environment, you have to produce something in order to go buy something, and then that's what generates demand and activity, and that's what sets prices within the economy. If the economy is slowing down, profit margins by their very nature and earnings growth will have to slow. And so this is going to be the big thing that we're looking for in earnings for the next quarter. And Mike, this is going to be one of the kind of the key issues for some of these companies that have probably run well ahead of what they're going to be able to produce earnings-wise, particularly in this recent AI chase run-up. Lots of expectations that we're going to have this explosive growth in AI and other areas. And we've talked about before is that whenever you have something like this occur, of course, NVIDIA has been one of the kind of the dominating companies in AI. Everybody's focused on it. And one thing we had talked about previously is that, well, when this happens, you're going to have new competitors drawn into the market to get in on the action, so to speak. And it was interesting that this morning there's an article out about a new company called Rebellion, just starting to make AI chips that will compete with and potentially outperform those made by NVIDIA. But this isn't a public company yet, but they're a young up-and-comer. But this is exactly the point, is that competition and these type of things are going to breed new competitors into a marketplace. And so, the ability to sustain extremely strong earnings, profit margins and earnings growth in an environment is going to be difficult if that economic environment is slowing.
Right. It's also deflationary.
Yep.
Right. The cure for inflation is inflation. As prices go up, more entrants come into the market to sell the product, especially when profit margins go up. And as such, you get more supply and it evens out the supply-demand equation, and that's the cure for inflation. And the problem we're having is that when the government interferes in that basic supply-demand equation, it screws things up. It's not reliable, it's not dependable money, it's impulses of money that affect supply or demand. And it's not just money, it's policies as well. We can look at the oil market, for instance. So the Biden administration released a lot of oil from our reserves. So they flooded the market with oil. Oil prices have come down relatively. And what's the reaction by the energy producers? They don't produce, right? They cut back on production. So the supply comes down. There's no one producing oil. And as a result, you're going to get a jump in oil inflation because there's no more supply coming from the SPR, because that's at what, 40-year lows at this point. And then at the same time, the production isn't where it should be based on what the economy is kind of saying it should be. So you get much bigger swings in inflation when you get government interference. And we've had more government interference in the last couple of years than we've had, in our lifetimes at least. So it's a really difficult environment because we're trying to look at these companies, and every company's individual. How much of inflation were they able to pass through? How much were they not? And how is that changing? We had a little taste of it a few weeks ago with Nike. Nike actually reports earnings about a month before. They're on a slightly different calendar than everyone else. And what they said is they could pass on some inflation, but customers aren't buying it as much. Mm-hmm. So even their sales rose, their net income fell. So that's going to be one of the keys that I'm looking for is, are customers still buying? Are they able to keep up, or are they shifting to cheaper brands? Yeah. Are they not buying certain products? And I think that and interest rates are going to be two big items, and it's going to be different for every company. If a company doesn't have debt maturing, they don't have to issue new debt, so they don't care what interest rates are. Conversely, a company that has a bunch of debt that just matured in June had to reissue 2% debt at 5%. That's going to cost. That's going to hit the bottom line. So I think this earnings seasons and this earnings quarter and the next few quarters going forward could be a little unique, as there's not really trends. There's company by company data, sub-industry by sub-industry data. Some industries may look really good, others may not look so good. And companies within those industries may vary quite a bit based on how they run their company, what type of products they sell, who they sell it to, and the power of those clients. So higher end versus lower end products, necessities versus non-necessities, how much debt companies have are all going to play a big role in earnings in a couple weeks, and then for the next few quarters here.
Yeah, and again, this is just the thing to keep a watch on because, again, expectations right now are very high in the markets overall. I mean, already expectations by S&P are that earnings will be at a record high by next year, and that the market will be hitting an all-time high by 2024. So, again, expectations are probably well ahead of what the economy can actually generate in terms of this. And again, profit. And again, this is the important part about this is when you hear stuff in the media about things like greedflation. Of course, you saw it, and people go running off. It's like, corporations are so greedy, et cetera. Just kind of set that off to a side because, generally there's other things that are going on. I'll just read to you a point about this from the Wall Street Journal as we close out this segment. While greed is timeless, companies conceivably may have more power to translate greed into prices because of declining competition. The Biden administration, for example, blames soaring meat prices in part on the consolidation among meat packers, but that wouldn't have translated into things into such high prices without the demand from locked down consumers and an industry enduring production interruptions and labor shortages due to COVID-19, drought, avian flu, and shrunken herds. So again, there's always the underlying issue that comes back to pricing, which is always a function of supply and demand. Now, whether or not companies can maintain those margins, that's a function of economic growth. We'll be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence and prepare for the second half of 2023 with the RIA Mid-Year Economic Review, Saturday, July 22nd, with Richard Rosso, Danny Ratliff, and special guest Chief Investment Strategist Lance Roberts. Get our report card for the market so far and what you need to know to invest profitably for the rest of the year. Register now for the RIA Mid-Year Economic Review, Saturday, July 22nd, with Ratliff, Rosso, and Roberts. RealInvestmentAdvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So I want to switch gears here real quick and talk a little bit about interest rates. I touched on this in the kind of the opening segment this morning that, interest rates have been creeping up here over the last few days. Really, a lot of it is kind of beginning of the quarter positioning. I wouldn't read a lot into it. Also, some of it is expectations that the Fed's going to hike rates in the short term. But again, as we were saying earlier, interest rates on the long end of the curve are a function of economic growth and inflation. And that's an important point when you look at long duration assets like technology stocks. And it's interesting because technology stocks have been rallying this year fairly strongly. Tech and NASDAQ's up 34% this year, which is a long duration asset because tech companies are dependent upon growth of earnings because they are needing high growth rates to support valuations. So they're considered to be long duration assets. Higher interest rates, obviously, would impact negatively that growth rate because higher interest rates slow economic growth. So, the interesting component here is that long duration assets are rallying sharply this year. Yes, everybody's chasing the FOMO right now of AI, but it's not paying attention to the fact that higher interest rates are going to weigh on the growth rates of those earnings. And it's just kind of an interesting, dichotomy that you have going on right now with that section of the market. Again, something is going to give here, so to speak. Either interest rates and inflation are going to continue to fall, which will support the rally in technology stocks, or if the people that are thinking that interest rates are going to go to 6-7% on the 10-year Treasury in the near future are right, that's certainly not good for the technology sector. So this is the real kind of issue. I'll just read to you a little quote from Yahoo Finance this morning. The U.S. 10-year Treasury note moved up to 3.9%, highest level since the mini bank crisis back in March. This essentially confirms the message from the Federal Reserve in its minutes that to expect more rate hikes this year despite the pause last month. Higher for longer is indeed the mantra. Meanwhile, the technology stock index has continued to surge this year. Bubble economics appear to trump real-world factors when it comes to stocks, and the technicals suggest the bullish move isn't over. And that's a true statement. The issue is when do the fundamentals matter? And the question is who's right? Is it the technology index, or is it the purveyors of doom saying that interest rates are going to move up to 6%? Both can't be right. Mike, what's your view here?
So I think earlier I used the word economics, physics economics, and it's basically that there are certain rules of economics that hold true. And one of those rules is that higher interest rates affect economic activity. And that's certainly true this time because we have more debt today than we had at any point in the past. So again, higher interest rates are going to weigh more heavily on the economy, but it's not happening. And it's kind of like the roadrunner and the coyote. The coyote runs off the cliff and he's in the air and he looks around, he looks down, and he has that OS moment, and then he falls. But there's that period where he's just levitating, essentially. And the economy is like that. The physics are saying that this economy should be doing pretty poorly here. But the markets, the NASDAQ, are saying it doesn't matter, everything's good. So, again, you look at these weird divergences in markets, because if you remember last year, the NASDAQ and bonds were almost perfectly correlated as prices, bond prices, and NASDAQ and long duration asset prices. Today, they're completely uncorrelated. Bond yields have been pretty much flat, and as you know, tech prices, stock prices have been rising. So which one's correct? And maybe yields are going to fall significantly, which would make the tech sector correct that they predicted it. But again, like you said, Lance, everyone thinks that rates are going to go higher. The Fed's going to raise rates and rates are going to go higher. It's just more pressure on an economy that, while it's not showing up, it's there. And when it does show up, it's going to create some real problems for the economy. And that's why I think the Fed is also they don't really want to hike rates anymore. They know that all their prior rate hikes are still, and Powell made mention of this last week or 2 weeks ago, that they know that those rate hikes are still not fully affecting the economy. So they don't want to get too far ahead of themselves, even though they may raise rates in late July when they have the next Fed meeting. Again, it's just strange anomalies in these markets, in the economy. We're going to see it in earnings. It's just all over the place. And you just have to, I think at the end of the day, base yourself and understand how our modern economy works. It's a debt-driven economy. You need debt to drive economic growth, and we're more reliant on that than ever before. Ergo, interest rates matter.
That's right. And again, this goes back to all of our conversation today, that interest rates and inflation and economic growth, kind of all matters ultimately at the end of the day. And that's, the issue we need to keep focusing on is that, there is this impact on economic activity, and economic activity is either going to start improving, and we're going to have a very sharp return to normal in both interest rates, in other words, the Fed cutting rates, and lower rates of inflation, or something else is going to happen. And, the bet right now is that we're about to have a very strong resurgence in economic growth and activity, which obviously would not correspond with falling rates of inflation. So it's interesting that the market is, and we've talked about this before, is that the market is putting the Fed in a very tough position, because the markets are suggesting and creating, not just suggesting, but they're actually creating easier monetary conditions, because it's making people feel wealthier, so they go out and spend more money. And that's exactly what the Fed's trying to stop. So it's going to be interesting to see this meeting coming up this month, what the Fed says, particularly when a lot of this data is suggesting that inflation potentially should actually start picking up. If we keep these numbers kind of going and employment remains strong, we keep seeing an uptick in services and economic activity, that's going to suggest higher rates of inflation by the end of this year. And it'll be interesting to see what the Fed does if inflation starts coming in hotter than expected and we start seeing the trend of inflation reverting to an increase rather than a decline.
Right. You can't really have your cake and eat it too. You can't have higher interest rates. You can't have higher inflation and the economy just humming along. It just doesn't work. One of the things have to be different. And I know I probably sounded very pessimistic there on the economy and what's going to happen. That doesn't mean markets fall out of bed. There's many ways that these situations can resolve themselves. For instance, inflation can keep coming down, the economy slows down, and interest rates drop like a rock to support the economy, and so it doesn't fall into a recession. Maybe we just get the soft landing, right? Which is the markets would like that. That would support, to some degree, current valuations, even though they are high. So, that's the other tricky part, Lance, is balancing all this, right? You have to balance economic views, what's happened in economic history. We know how this plays out. It's a question of when and to what degree. But that doesn't mean that stocks, bonds, commodities, every other asset, real estate, does one thing or the other, because every environment can be unique. So, we have to kind of pay close.
Yep.
Also, the fundamentals.
Go ahead. Well, yeah, we lost you there just in the last little sentence. So, but I got the point is that we've got to pay attention to these fundamentals, because this is going to be what matters ultimately to whether or not stocks can keep growing at this rate, and whether they will. And again, as we've talked about before, there's a lot of very cheap, undervalued companies in the market that are not participating this year because investors really aren't paying attention to the fundamentals. It's all about the AI and the FOMO right now, but eventually fundamentals do matter, and they always matter in the long run. And so balancing that in a portfolio as you're trying to manage your money is keeping a focus on these fundamentals, because the fundamentals will matter. They may not matter today, but they will matter over the long term. Mike, last word before we wrap up?
Well, I was just going to say 2% inflation and 1% Fed funds and much lower mortgage rates are very supportive for economic growth. The question is, how do we get there? And if we can get there in a way that the market that's not problematic, that can be a good thing for stock prices.
Absolutely. All right. Be sure and get by the website, realinvestmentadvice.com. Make sure you're registered for our upcoming mid-year economic review. I'll be joining Danny and Rich to do a mid-year update, market recap, where we are, where we're looking out to go to next. So make sure you're registered online for that event. We'll send you the link for that event. It's coming up July the 22nd. It's at 8 a.m. It's Saturday morning. So just, they're determined to ruin my Saturday. But we'll do that on July the 22nd. Also, while you're there, make sure and send your questions, your comments, emails. Always happy to help you out. Make sure you get registered for our weekly newsletter that comes out Saturday. So if you subscribe at the website, you'll get an email for that. Also, we email you our Technically Speaking Tuesday post as well, where we cover the markets from a technical perspective. So if you sign up on the website, also our daily market commentary that Mike and I produce every day, that comes out by 7:30. Lots of stuff for you to subscribe to at the website. Keeps you up to date on the markets, what we're thinking, what we're doing. All on the website, realinvestmentadvice.com. All right, have a great day, and we'll see what the markets do. Danny and Rich here tomorrow to pick up for Financial Fitness Friday, and I will see you back here on Monday. Have a great weekend.